Picture someone you probably know. Maybe it's even you. They make $65,000 a year. Not wealthy, but decent. Stable job. Regular paycheck. And here's what's interesting. Their bank just approved them for a $15,000 car loan. They've got $8,000 available across their credit cards. A $40,000 personal line of credit they could tap into tomorrow if they wanted. Add it all up, and they have access to $128,000 in purchasing power. So they should feel financially comfortable, right? They should have options, room to breathe, the ability to handle whatever comes up. Instead, they check their account at the end of the month and there's $127 sitting there. $127, not $127,000, just $127. And it's been like this for years, even as their salary went up, even as banks kept approving them for more, and they have more access to money than ever before. Yet somehow they have less money than ever before. If you've ever stared at a pre-approval letter and thought, the bank says I can afford this, but I have no idea where that money would actually come from, this video is going to clarify something important that's been hidden in plain sight. I'm Rickard, and I spend a lot of time analyzing why people who earn solid incomes still end up with nothing at the end of the month. What we're looking at here isn't a spending problem or a discipline problem. It's a structural problem that most people don't see until it's already locked in. Here's what everyone believes. If you have access to credit, you have more financial capacity, more options, more flexibility. It's treated like having extra money available when you need it. And on the surface, that makes perfect sense. If you make $65,000 and you can borrow another $20,000 when needed, and you effectively have $85,000 worth of capability, right? Except that's not how it works, not even close. What actually happens is something that shows up in millions of bank accounts, but almost never gets explained clearly. Every dollar you borrow doesn't add to your financial capacity, it subtracts from it, permanently, and the subtraction is larger than the amount you borrowed. The mechanism that makes this happen is precise, measurable, and completely predictable. And once you see how it works, you'll understand why someone can get a raise every year and still have less money left over than they did 3 years ago. If you're someone who's felt this disconnect between what you earn, what you have access to, and what's actually available, subscribe to the channel. I break down the financial mechanics that nobody explains clearly, and understanding how these systems actually work is the only way to make different decisions. Hit the like button if this is starting to click into place for you. Here's where it gets strange. Let's say you walk into a bank or apply online for financing. You fill out the forms, list your income, and within minutes they come back with a number. You're approved for $40,000. They're confident about it. Their algorithms ran your salary, your credit score, your employment history, and they determined you can handle a $40,000 loan. Now go home and look at your actual budget. After rent, utilities, insurance, groceries, and the minimum payments you're already making on existing debt, you've got maybe $400 left at the end of the month. Some months less. So which number is real? Can you actually afford $40,000 in new financing, or can you afford $400? Both can't be true. And yet one of those numbers is driving major financial decisions. Here's what that $400 actually represents. Let's say you bring home $4,500 a month after taxes. Before you even think about rent or food, you've got payments going out. Car payment, $380. Credit card minimums, $240. Personal loan from 2 years ago, $175. That couch you financed, $95 a month. Phone and tablet on a payment plan, $85. That's $975 leaving your account every single month before you've paid for a place to live or put groceries in the fridge. Those aren't choices you're making this month. Those are decisions you made months or years ago that are still running, and they don't stop. Here's what makes the bank's numbers seem believable. When you borrow money, it shows up all at once. You finance a car, and that car is sitting in your driveway today. Furniture financing? The couch arrives this week. The benefit is immediate and complete, but the payment doesn't work that way. That payment shows up every single month for the next 60 months, 5 years, And it's not like the couch is getting delivered in small pieces over those 60 months. You got the whole thing up front, but you're paying for it in 60 separate transactions. That timing mismatch changes everything about how affordable something actually is, and most people don't catch it until years later. Let me show you what this looks like with actual numbers. Say you make $65,000 a year. That's your salary. But if you're making payments on a car, add a couple credit cards, maybe some furniture financing, and a personal loan, those payments might total around $975 a month. That's $11,700 a year. So take your $65,000 salary and subtract that $11,700 debt payments. What you're left with is $53,300. That's your effective salary. That's what's actually available for rent, food, savings, everything else. You're not earning $65,000. You're earning $53,300. The difference is already spent before you even see it. And here's where it gets worse. Most people assume that as their salary goes up, they'll start to feel better financially. So let's track what actually happens over 3 years. Year 1. You're making $65,000. Monthly debt payments are around $280. After covering those, you've got about $4,200 a month for everything else. Year 2. You get a 3% raise. Now you're at $67,000. But you also financed a phone, picked up another credit card, took a small personal loan. Debt payments are now $615 a month. Money available? Down to $4,000. Year 3. Another raise. $69,000 now. But more financing got added. Payments hit $975. Available income drops to $3,800. Your salary went up $4,000, but you have less money than you did 3 years ago. Now here's the part that keeps this locked in place. Let's say you finally pay off your car after 5 years. That $380 monthly payment is done. This should be the moment where you suddenly have an extra $380 every month. Real breathing room. But what usually happens? The car's older now. Maybe it needs repairs. Or you just want something more reliable. So you go finance a new one. And guess what the payment is? Right around $380 a month. Different car, same payment. That slot never actually empties. It just gets refilled. The payment becomes permanent infrastructure in your budget, rotating between different purchases, but never actually going away. And there's another layer to this that makes it even more expensive. When you borrow money, you're typically paying somewhere between 7% and 22% in interest. Depending on what you're financing. Credit cards are often at 18% or higher. Meanwhile, if you actually have savings somewhere, you're earning maybe 4% to 5% at best. Most savings accounts pay way less than that. So let's say over 10 years you borrow $50,000 total at 15% average interest. Compare that to saving $50,000 at 4%. The difference between those two paths isn't just $50,000. It's over $67,000. You're not just spending the money. You're paying a massive premium to spend it now instead of later. This is what breaks the pattern, recognizing what affordable payment actually means. When you're deciding whether to finance something, the question is usually, can I afford $350 a month? And if your budget has $350 available right now, the answer feels like yes. But that's the wrong question. The real question is, can I afford to reduce my available income by $350 every month for the next 60 months? Because that's what you're actually agreeing to. Not a one-time cost. A permanent reduction that stacks on top of every other reduction you've already locked in. Just because you have room for the payment today doesn't mean you can actually afford what that payment represents. So here's what actually changes things. Stop adding new payment obligations. That's it. Don't take on new financing. Don't open new credit lines. Don't add another monthly commitment. Just let what you already have run its course. Your car loan has 36 months left? Let it finish. Credit card getting paid down? Keep going until it's done. Here's what happens. Every time one of those payments ends, that money doesn't disappear. It becomes available again, permanently. A $380 car payment finishing means $380 more every single month from that point forward. Most existing debt clears in 36 to 60 months. That's 3 to 5 years to get back to your actual salary. Here's what it comes down to. Available credit is not the same thing as available income. When a bank approves you for financing, they're not telling you that you can afford it. They're telling you that you qualify for the payment. Those are completely different things. The illusion is thinking that access to more credit means you have more money. It doesn't. Yeah, it means you have access to more obligations. The path to actually having more money isn't finding new ways to borrow. It's removing the reductions that are already eating into what you earn. That's the only math that actually works.